Good afternoon, everybody, and welcome to today's webinar. I am Matthew Saha. I lead our not-for-profit industry practice for the firm, and it is great to have everyone with us for what is the last session of our calendar year 2023. So we're finally here at the end, and happy today to have a great session that we usually do around this holiday time of year, which is to have our not-for-profit tax update. So we're thrilled that you could join us. As a reminder to answer those polling questions if you want to get CPE questions or want to get CPE for the session. There will be 5 polling questions today if you're counting, so make sure that you get as many of those as possible. And then I would like, without further ado, to introduce our speakers for today. And we're very happy to have both Paula Wendling and Breanne Widener with us. Paula and Breanne serve in our tax-exempt tax practice for the firm, and they'll be walking us through today's important topic of NFP tax updates. But of course, before I hand it over to Paula, it wouldn't be a series without a quick dad joke, if you will humor me, Paula. So I have a question for you, holiday related here. What advice do you give to a gingerbread man who complains about a sore knee?
I'm not sure what that advice is, Matthew.
Try icing it. So there you go. I hope that gave you a chuckle. But Paula, Breanne, thank you so much for joining us today, and I will turn it over to you.
Thank you, Matthew. As Matthew said, my name is Paula Wendling, and Breanne and I are looking forward to spending this time with you all to go through some 4 major categories of updates in the nonprofit federal tax world. Our agenda today includes form updates and reminders, legislative highlights, what's new with the IRS, and other developments in the nonprofit tax world. We're going to jump right into our first polling question and start us off right. Have you made a charitable contribution yet in 2023? We know many of you have just gone through some form of Giving Tuesday. In my home state of Colorado, today is Colorado Gives Day, and there are many others like it. So you have many opportunities to participate in charitable giving if you haven't already. It looks like some of our participants may be struggling to vote in this poll. Heather, is that something that you might be able to help us with?
Yeah, we'll work with them on a one-by-one basis.
Okay. Very good. Well, we're going to go ahead and move along, and I'm going to turn it over to Bree to jump right into form updates.
Thank you, Paula. Regarding form updates, the good news is there's not a lot to share here. The 2022 Form 990 series returns only had minor clarifications and updates. The majority of the updates revolve around either mandatory electronic filing or new ways to make online submissions, which supports the overall IRS plan to focus on a better taxpayer experience and better use of technology. Starting off with electronic submissions, all Form 990 short period returns must now be e-filed and a Schedule O disclosure added if the short period filing is due to a change in accounting period. Forms 8940, which are requests for miscellaneous determinations, can now only be filed at the pay.gov website. Exempt organizations use this form to request changes in foundation status, exemptions from Form 990 series filing requirements, and advance approvals of certain actions by private foundations. This form must now also be used for requests by a government entity for voluntary termination of exempt status under IRS Section 501c3 and by certain private foundations waiting to terminate their private foundation status under IRC Section 507b1b. And lastly, private foundations are no longer able to paper file forms 4720. They will be rejected and sent back, similar to how paper filed Form 990 series returns are handled today. Public charities may still file paper, but should consider electronic submissions if available. And while we're discussing electronic submissions, it's important to note that a few state UBIT-specific returns now require form submission on their specific websites versus electronic filing. The New York Char 500 and the Connecticut and Massachusetts UBIT returns immediately come to mind. Regarding compensation reporting, the IRS changed the rules for determining common law employees across all Form 990 series returns, substituting federal law for state law as the basis for such determinations. Now, filers must report payments to management companies, leasing companies, and professional employer organizations, or PEOs, as compensation to its own employees if the payments are for the services of the filer's own common law employees as defined under federal law. For taxable expenditures, a warning was added to the Form 4720 instructions that private foundations must not pay a disqualified person's excise tax, since that payment would be considered self-dealing. And the instructions were also updated to emphasize a filing organization should only report its own IRC Section 4960 excise tax and not a disqualified person's. The IRS updated its FAQs and a user guide on submitting the 990N postcard. The two sign-in options are available through login.gov and the new ID.me. One item that we wanted to remind everyone about today is the responsibilities organizations have for accepting charitable contributions, whether they are cash or non-cash. Without a written acknowledgement, donors are not permitted to claim a tax deduction for a single contribution of $250 or more. This is not going to generate a penalty to the organization by the IRS, but it is in the best interest of the organization to provide all donors with written acknowledgement, if for anything else, to encourage future donations. Charitable organizations are required to provide a written disclosure, which is different from a written acknowledgement, to a donor who receives goods or services in exchange for a single payment in excess of $75. The written disclosure should inform the donor of two things. One, that the amount of the contribution is limited to the excess of money contributed over the value of goods and services provided, and two, a good faith estimate of the fair market value of the goods or services provided. The big takeaway to remember for cash versus non-cash charitable contributions is that for non-cash contributions, organizations should refrain from valuing the property. This is the donor's responsibility. Organizations should also be aware of other potential filing requirements related to non-cash charitable contributions, such as Form 8283 and Form 8282. Organizations should be asked to sign Part 5, the donee acknowledgement of Form 8283 for certain non-cash contributions greater than $5,000. Form 8282 is required if the donee organization disposes of certain charitable deduction property within 3 years after the date the original donor contributed the property. While we are discussing non-cash contributions, a quick note regarding cryptocurrency. 2 IRS Chief Counsel advice memorandums were issued at the beginning of this year, both concluding that cryptocurrency is not a security under IRC Section 165 G2. This is helpful for tax-exempt organizations to be aware of if they regularly accept cryptocurrency, because it could impact a loss deduction the donor was expecting, or it may require a qualified appraisal if the contribution was over the Form 8283 $5,000 threshold. we thought it would be helpful to show a few examples of written acknowledgements that we typically see. This first example is simple and to the point, highlighting the amount of cash received, the date of the contribution, and that no goods or services were provided. This next one is a good example of a non-cash contribution, and note no dollar amount provided for the baby crib. This third one shows the value of goods and services received, which should be considered when the donor files their return with the contribution included. And this last example should help organizations that struggle to complete lines 8A through 8C of the core form, Part 8, Statement of Revenue, and potentially Schedule G fundraising. This type of acknowledgement is important to capture correctly what is truly a contribution versus what is gross income from an event. This information can be tricky to gather for tax return reporting purposes so far after the fact of the event without good books and records. The other form reminder we wanted to discuss today deals with the excise tax associated with excess compensation paid to certain executives and other highly paid employees. This has been around for a few years now, but with more IRS scrutiny surrounding the Form 4720 filing, we thought it was worth mentioning today. So as a friendly reminder, without getting into all the nuances and definitions, Section 4960 of the Internal Revenue Code imposes a 21% excise tax on remuneration in excess of $1 million, as well as excess parachute payments paid by certain tax-exempt organizations or their related entities to any covered employee. If the $1 million threshold doesn't apply to your organization, it is still necessary to document and track who the covered employees are, which should be the top 5 highest compensated employees for the current calendar year and the previously identified covered employees. The list of covered employees should be maintained on a calendar year basis regardless of fiscal year end, since the information needed for the filings is gathered from W-2s. And one last point to remember about covered employees: once an employee is considered a covered employee, they are always a covered employee and should be tracked every year moving forward. And I think that brings us to our next polling question. What key trends are you seeing in your organization? Be interested to see what wins here, Paula.
Yes.
We'll give everyone a little bit more time. How are we doing, Heather?
We'll give everyone about 10 more seconds. All right, we've closed the poll.
Excellent.
Thank you, Heather. In our conversations with clients and colleagues this year, we have heard the repeated themes of returning to normal and also discovering what the new normal truly is. In many ways, we are seeing similar themes play out in the national legislative agenda, moving through crisis management and back to addressing some long-standing guidance. Our first piece of legislative update refers to the Secure Act 2.0. This is the Setting Every Community Up for Retirement Enhancement, or SECURE, and was signed into law on December 29th of 2022. The act contains a wide variety of changes to statutes covering retirement plans, ranging from automatic enrollment requirements for participant contribution limits, allowable investment vehicles, and specific age provisions for distributions as well as participant requirements. We expect that your various benefits administrators in your organizations have been on top of most of these changes impacting employer plans, including Section 403B plans and 457, and related contributions throughout 2023. As we near the end of 2023, of particular note for development officers or others who are assisting with fundraising in today's audience, are two provisions enabling potential donors to increase charitable contributions while meeting their required minimum distribution requirements beginning in 2024. The first provision indexes for inflation the maximum qualified charitable distribution, or QCD, from an IRA. The QCD was first created with the Pension Protection Act of 2006 to allow individuals to make distributions directly from an IRA to a public charity of up to $100,000 annually. That $100,000 limit has remained static since the PPA was enacted. With the Secure 2.0 Act beginning in 2024, that maximum QCD has been increased to $105,000, and that limit is subject to inflationary adjustments each year thereafter. The second provision of note in the Secure Act allows a one-time election to distribute up to $50,000 from an IRA to a split interest entity, such as a charitable remainder trust or a charitable annuity trust. That elective amount is indexed to inflation, so this may be a key planning point for your potential donors and their advisors as they consider the timing of such a charitable set-aside. More recently, final regulations addressing Type 1 and Type 3 supporting organizations were issued on October 16th. These regulations under Section 509A adopt 2016 proposed regulations with some minor changes. To be classified as a public charity, an organization must be described in Code Section 509A1, 2, or 3. Organizations described in 509A3 are known as supporting organizations, and they achieve their public charity status by providing support to one or more public charities described in 509A1 or 2. These are referred to as supported organizations. Under Section 509A, Type 1 and Type 3 supporting organizations may not accept contributions from any person who controls the governing board of the supported organization. If such contributions are received, a Type 1 or Type 3 supporting organization will automatically convert to a private foundation. In general, under the 2016 proposed regulations, the governing body of a supported organization is considered controlled by a person if that person, alone or together with certain related persons, can aggregate their votes or positions of authority and may require the governing body of the supported organization to either perform any act that significantly affects its operations, or 2, may prevent the organization or the governing body of the organization from performing those operations. The final regulations make clear that control exists if certain persons, as defined in the regulations under 509A, holds 50% or more of the total voting power of the governing body, or have the right to exercise veto power over the actions of that body. The regulations further incorporate a facts and circumstances test in determining such control. Further, those regulations that were finalized in October also contain provisions related to the Type 3 supporting organization relationship test and the notification requirement, the responsiveness test, and an integral part test as component factors of the relationship test. The provisions include guidance regarding the means by which a supporting organization may report to its supported organization, including electronic transmission of required information and summary reports of activities conducted during the supporting organization's year. Those final regulations adopt the 2016 proposed regulations with some clarifications and additional examples as requested by some of the commentators. And then just very recently, the Treasury issued proposed regulations for donor-advised funds. Donor-advised funds continue to be popular vehicles for charitable giving for many donors, largely because they reduce the costs and administrative burdens for large charitable grants and investing. Grant making from DAFs has increased year over year since 2009. And for some background regarding recent events, Congress included special provisions in the Pension Protection Act of 2006 to address the potential for abuse by donors using DAFs to set aside funds, potentially for themselves or their own use, while taking charitable contribution deductions. The PPA imposes certain excise taxes on transactions with donors, donor advisors, and certain related parties, and on taxable distributions from DAFs. On November 13th, the Treasury released proposed regulations under Code Section 4966 regarding these excise taxes to provide clarity regarding the types of funds qualifying as DAFs and the distributions from such accounts that may be taxable. Key definitions include DAFs, separate entities, advisory privileges, and taxable distributions. Of particular note, the role of personal investment advisors may potentially be substantially impacted by these regulations. The regulations apply to community foundations or other charitable organizations that maintain one or more DAFs, and to certain donors, donor advisors, related persons, and fund managers. Comments must be submitted by January 16th, 2024.
I think that brings us to our next polling question. And I find this one to be hilarious for accounting humor. But how should Form 990, Form 990EZ, and Form 990PF be filed with the IRS? I'm guessing the audience will get this one right, Paula.
We certainly hope so, Bree.
Yeah, I just had a question come in from the audience, and they're wondering, do they have to submit these through e-file?
I think that is best if they want them to be accepted, yes.
Okay, got that polling question.
We'll leave this open for a few more seconds. All right, I think we're ready to move on. So what's new with the IRS? The IRS continues to be vigilant about alerting taxpayers, businesses, and tax professionals about the latest schemes. The top 12 scams for 2023 was published earlier this year and is worth highlighting a few today. The employee retention credit claims. Avoid aggressive pitches from scammers who promote large refunds relating to the employee retention credit. Phishing and smishing. Taxpayers and tax professionals should always be on the alert to fake communications from those posing as legitimate organizations in the tax and financial community, including the IRS and state governments. Fake charities. Be wary of new charities created after a crisis or natural disaster. Unscrupulous tax return preparers. Avoid tax return preparers who refuse to sign the return with their PTIN or who charge a fee based on the size of a refund. These are major red flags. Social media can circulate inaccurate or misleading tax information. Taxpayers are encouraged to remember that if something sounds too good to be true, it probably is. And then lastly, schemes with international elements. The IRS continues to identify individuals who attempt to conceal income in offshore banks, brokerage accounts, digital asset accounts, and nominee entities. Asset protection professionals continue to lure U.S. persons into placing their assets into offshore accounts and structures, saying that they are out of reach for the IRS. These assertions are just not correct. The IRS can identify and track anonymous transactions of foreign financial accounts as well as digital assets. The IRS is well aware taxpayers faced a number of issues due to the tax law changes that took place in the last fiscal year and ongoing challenges relating to the pandemic. Significant focus of the IRS in the tax exempt and government entities division remains on improving taxpayer services, expanding enforcement of the tax law, and better utilization of technology and data analytics. Here are a few examples of their efforts. Although the goal was for taxpayers to see fewer notices, at the current time, we are seeing an uptick in notices to our clients as the IRS continues to play catch up from the 2019, 2020, and 2021 tax years. Not only should organizations be concerned with ensuring their 990 series returns are being filed on time, but all tax filings. As the IRS workforce continues to grow and technology improves, expect more attention on other various filing requirements. The current compliance strategy focuses on issues that have been on the back burner, such as meeting the community benefit standard for tax-exempt hospitals, federal unemployment tax and excise tax filings, employment tax compliance, and inaccurate postcard filings, which is the 990N. This next fiscal year, the Tax Exempt and Government Entities Division expects, from a compliance perspective, to focus on expanding examinations, addressing schemes by unscrupulous promoters, tax credit compliance, and underpayment and non-filing. Their overall priorities aim to support the IRS strategic operating plan, which heavily involve changes to the workforce and technology. We should expect to see a focus on improved education and outreach to taxpayers, faster issue resolution, which processes claims faster, streamlined notices and improvement on how they are updated and issued to taxpayers, improved data analytics to refine how EO cases are selected, improved efficiencies of referrals and examinations, and career and workforce development initiatives created to empower employees. With all that the IRS has to focus on, I found it interesting to see how tax-exempt organizations stacked up to other business returns. For fiscal year 2022, the IRS received approximately 14.1 million business returns. Now, flow-through entities captured the largest percentage of those returns, but tax-exempt organizations remained consistent over prior year with 12% of the tax filings, the lowest percentage of the business returns, but not far behind taxable corporate returns. Collections from unrelated business income filed on Forms 990T was just over 1.4 billion. Amazing. And lastly, examinations of tax-exempt organizations were less than 1% of total tax-exempt filings for fiscal year 2022, which seems to be the trend. Moving on to states, out of those 1.7 million federal tax-exempt returns filed in fiscal year 2022, these 6 states represent where the highest electronic submissions were sent from. California by far the highest with approximately 140,000, and Texas and New York close to 100,000 each. This list surprised me a great deal. I wasn't expecting Ohio or Illinois to be so high on the list, beating out Maryland, DC, and Virginia. And I'm not just saying that because I work out of the Tyson's Virginia office. Last, highlighting tax-exempt applications, the IRS closed 136,000 applications for tax-exempt status during fiscal year 2022. 87.7% were approved. No surprises here that 501c3 organizations made up the majority of the applications filed during fiscal year 2022. And I think that brings us to polling question number 4. Has your organization done any tax planning? Yes, no, or not applicable?
And while people are answering that poll question, we had one question. I do not know the answer to this. Wanted to see if you guys have any thoughts, but someone asked if there's any recommendations for an easy and cheap platform to file just a handful of Form 1099s. Like they have maybe 2 to 5 Form 1099s. Any suggestions? Any recommendations for that?
Not without doing a little bit of research, I don't. Paula?
In my experience, I have used QuickBooks in the past to file those forms if you have access. And there are sometimes off-the-shelf software packages that you can purchase at some place like Staples or Office Depot. And you can use a web-based program to prepare and file those returns.
We did have one person who looks like they suggested e-file my forms. I'm not sure if that's a website or a technology, but they have provided a link to that. So we'll post that in the chats down there too. But it looks like several people in the audience have some recommendations here. So we'll make sure to post those.
Thank you, everyone, for sharing those recommendations. It's great to have a community that has the experience we need to share with one another. We do hope that even though you may be with an exempt organization, that you have been doing some tax planning. One of the features of an exempt organization is that it often undergoes more scrutiny by the IRS than taxable counterparts, simply because it is exempt and the statute requires a lot more oversight by the IRS and other governmental agencies. So we'd like to step into our 4th major component of our presentation today to cover some other developments in the nonprofit federal tax world. And we're going to start with a deeper dive into issues related to exemptions that hospitals have received over the years. Concern over the extent to which tax-exempt hospitals provide adequate care for poor and underserved populations in the U.S. continues to grow. Since before the enactment of the Affordable Care Act, this has been a concern, and there have been many reports from Congress and related organizations, governmental organizations, addressing the lack of clarity regarding community benefit standards and how to assess what charity care has been provided and what charity care needs to be provided by exempt hospitals. In August of 2023, the Senate Finance Committee members sent letters to the Treasury Inspector General for Tax Administration and the IRS urging evaluation and increased oversight of hospital systems by the IRS. You may recall that the Affordable Care Act enacted Section 501R of the Internal Revenue Code, and by doing so, it moved oversight under the purview of the IRS at that time. Even more recently, in October of 2023, the Senate Health, Education, Labor, and Pensions, or HELP Committee, released a majority staff report outlining policy concerns. This report studies 16 of the largest nonprofit hospital systems in the U.S. and addresses findings from qualitative and quantitative analysis of systems' estimated tax benefits from their exempt status versus the reported amounts of charity care and community benefits provided by those systems. The report addresses issues such as an increased revenue and net profit from hospital systems during years 2011 through 2019, increased cash reserves, and a decreased average charity care spending during the same periods as reported on Schedule 8 of Form 990. The report also addresses the issues perceived in executive compensation levels and increased amounts there. And it addresses aggressive means of collections, including wage garnishment and placing liens on patients' personal property. This report from the HELP Committee includes some stories from patients and addresses a number of individual situations with the outlook and the potential conclusion that hospital systems are perceived to be taking advantage of the poor and needy in their communities when their exempt status means that they are expected to provide care for those same persons. Among the recommendations in the report are establishing clear, enforceable standards for financial assistance programs, expanding requirements established under the Affordable Care Act to require nonprofit hospitals to go beyond identifying needs raised in community health needs assessments to specifically addressing those needs. And then modifying Form 990, Schedule H, reporting requirements to provide clarity regarding community benefit provided on a facility level rather than a system-wide level. This part of the modification may require changing definitions of what facilities are and other terms that may be unclear or possibly in conflict with the intended results in the reporting instructions. To be sure, the hospital and the exempt hospital industry is complex, and this is an area of the law where a lot of clarity is still yet to be sought. There is much dialogue and problem solving to be done, both within the systems and within Congress, and the IRS's resources remain limited. So as Bree discussed earlier, clarity regarding hospital system reporting requirements is one of the IRS's priorities, but they have so many multiple directions where they're spreading their priorities. Resolution to the exempt hospital operating and reporting concerns continues to remain uncertain. Another area that has been developing further in recent months is related to the 1023 EZ application. The IRS first released Form 1023-EZ in 2014 in order to streamline the exemption application process for certain nonprofit organizations. Generally, smaller startup organizations will use Form 1023-EZ. In contrast to the full Form 1023, which requires applicants to attach supporting documents such as bylaws, conflict of interest, and non-discrimination policies, the Form 1023-EZ does not require any such documentation to be attached. Unsurprisingly, some filers of the 1023-EZ have utilized the simple application for their own gain. The New York Times wrote an article about a particular person who was able to get 76 fake nonprofits approved for exemption by the IRS. He used organization names similar to existing well-known charities, and he used a single PO box for every one of the organization addresses. Unfortunately, he was able to use these fake organizations to receive contributions from donors who believed they were giving to legitimate charities. Most of the applications that he submitted were Form 1023-EZ. In 2016, Treasury Inspector General raised concerns regarding the high rate of applications being approved. Bree mentioned earlier that last year, 87.7% of the applications submitted had been approved. In late 2022, the Treasury Inspector General for Tax Administration released a report detailing criticisms of the Form 1023 application. Among those were the Form 1023 requires applicants to attest rather than demonstrate that they meet the requirements for Section 501c3 status. Organizations are not required to submit their organizing documents to the IRS, and instead they attest that they meet those organizational requirements. Through its testing of the application process and examination compliance efforts, the Treasury Inspector General determined that the information provided on the Form 1023-EZ is insufficient to make an informed determination about tax exemption and tax exempt status, and it does not educate applicants about the eligibility requirements and the maintenance requirements for tax exemption. The IRS relies on a Form 1023 examination after the fact. That's their strategy to detect noncompliance only after organizations are approved. However, as Bree mentioned earlier, less than 1% of tax-exempt organizations are examined each year. In its 2022 report, the Treasury Inspector General recommended that the IRS, 1, revise the activities narrative section of the 1023-EZ to expand what charities need to describe on the application. 2, assess the feasibility of requiring applicants to submit their organizing documents as an attachment to Form 1023-EZ. 3, notify applicants when additional time is needed to process their applications. And 4, update online guidance with accurate information about the application process for 1023-EZ filers. IRS management responded and agreed with the second and fourth recommendations, those being assessing the feasibility of having bylaws and other organizing documents attached, as well as updating their online guidance. IRS management disagreed with the idea that they need to revise the form to allow for a greater narrative of what each organization's activity is. So There hasn't been a lot of resolution to the 1023 EZ filing issues or concerns, but the IRS continues to hold that they will catch bad actors on the back end with their examination process. In a relatively new development, there is more and more said and known about NIL collectives. What is an NIL collective? It is usually a public charity that helps sponsor student athletes so that their name and image and likeness can be used and can help them earn compensation for use of the NIL. You may remember in 2021, the NCAA adopted the interim name, image, and likeness policy, whereby student athletes are now allowed to be compensated for the use of their NIL without jeopardizing their NCAA eligibility. Since that interim policy was adopted, many new organizations, referred to as these NIL collectives, have been founded by boosters, fans of university athletic programs, and others. And these NIL collectives develop, fund, and or facilitate NIL deals for student athletes. Student athletes are compensated for services that they provide under these agreements, and in some cases, nearly all of the collective's expenditures go toward this compensation of the student athletes. And in some cases that have been noted, 100% of the available funds have been used for compensation. Some collectives are formed as nonprofit entities and have applied for and received recognition of tax exemption under Code Section 501c3 using Forms 1023 and 1023 EZ. Others have arranged fiscal sponsorship under a donor advised fund or another public charity. And some have been organized as an activity or program of an existing exempt organization that supports an affiliated university athletic program. In May 2023, the Office of Chief Counsel issued a legal advice memorandum addressing the qualifications for exemption of NIL collectives. The memo analyzed statutes and case law regarding private benefits provided by nonprofit organizations. A single non-exempt purpose, if substantial in value, will preclude an organization's exemption. The memo concluded that private benefit provided to student athletes in most cases of these NIL collectives will be enough, more than incidental in qualitative and quantitative sense, and therefore most NIL collectives are not organized and operated exclusively for exempt purposes. While the legal advice memo that came from the Chief Counsel's office does not constitute proposed or pending legislation, and it does not create a precedent, this is an important issue for NIL collectives, founders, universities, potential fiscal sponsors, and other interested parties, all of whom should be aware of the issues coming forth just this year. With that, we're going to jump back to our last polling question, which is, what potential nonprofit tax trap concerns you the most? Payroll taxes, unrelated business income taxes, political advocacy, or excessive compensation? We'll give you a moment to answer. As we were preparing for our presentation this morning, I was reminded that in the unrelated business income taxes section, just a reminder that many organizations may have a payment due here in the middle of December. And the IRS just announced this week that their current interest rate on underpayment is 8%. So if you're one of those organizations that has typically waited to pay balances due when they're fixed and determinable, you may decide that it's time for you to start putting some estimated amounts on deposit.
Very good tip, Paula.
How are we doing, Heather?
I'm gonna go ahead and close the poll now.
Okay. Very good. With that, we'd like to conclude our presentation today. Matthew, have there been any additional questions posted in the chat?
Only one additional question for you, which is, what do snowmen eat for breakfast? It's,
I can't.
It's Ice Krispies. Ice Krispies. I told my daughter it must be carrots, and she said, "Why would they eat their own nose? That would be crazy." I'm like, yeah, well, that doesn't make sense, does it? Well, thank you so much, Paula and Brianne, for this update. I certainly learned a ton and a lot of great reminders, so I really appreciate that. Just a reminder, this is the last session of our 2023 Not-for-Profit Speaker Series. So thank you to all of those who joined us throughout the year for all the great topics that we had this year. We are well into the process of planning for our 2024 Speaker Series, and we will be posting more information about that early in 2024 to our website, and then sending out an email to everybody on our not-for-profit distribution list to bring your attention to sign up for the 2024 series. So we'll have a lot of great topics in 2024, some popular speakers back by popular demand, and just look forward to joining you once again in the new year. So until then, happy holidays to everybody. And again, thank you for joining us, and have a great rest of your day.